Hello and welcome to Pensions in a Pod, a podcast series by Eversheds Sutherland that keeps you informed on topical issues within the pensions and benefits world. I'm Jeremy Goodwin, partner and head of pensions, and in each episode within this series, we'll hear from speakers across our pensions and benefits team. In this month's Pensions in a Pod, we look at the recent autumn budget about which there's been so much speculation in advance on pensions tax reform. Now, I think it's fair to say that we didn't see the reform that we expected, but we did see a significant extension to the range of death benefits that will become the subject of inheritance tax on a member's death, with the changes coming in from April 2027 and an increase to the rate of employers' national insurance contributions. I'm truly delighted to be joined this month by both my fellow pensions partner, Ele Lovering, and the former pensions minister, Baroness Ros Altmann. Reading Ros's Wikipedia page in preparation for this podcast, you really understand the extraordinary life Ros has led, campaigning for pensions reform and social justice. I'm truly looking forward to hearing her views on the pensions aspects of the budget. So let's get to it. Ros, first of all, as I said, in the recent budget, the Chancellor announced that the government will bring most unused pension savings and death benefits into the inheritance tax regime from April 2027. One of the motivations behind this change, we assume, is to encourage individuals to use their pension savings as a retirement income rather than as a way to build up and pass on wealth to the next generation. Do you see any unintended consequences of this?
I certainly do. I think this announcement is going to have terrible consequences on pensions. It takes us back potentially to some of the dark days when either people had to buy an annuity because they felt somehow that that was what was required of a pension, or indeed it was mandated. They had no choice. Or they went into drawdown, and then when they were in drawdown, they tried to empty the pot as quickly as possible, because if they died and hadn't spent it, there was a 55% charge to tax. Now, if these changes go ahead, and I say if because they're so bad, I hope they won't, by 2027, people will not want to keep money in their pensions into their 80s and 90s. And that's terrible, because that's not what pensions were meant to be about. They will become some kind of spending pot as soon as you can. Empty the fund just in case you might die unexpectedly soon. On top of that, death benefits that are attached to some pension schemes could well, at the moment it looks like they definitely would, be caught in this 40% trap, which means that your loved ones and the benefits that your employer has promised you and that you were expecting if you pass away won't be there at the level that you were expecting or indeed promised. So there are real dangers in trying to unpick the pension freedoms which were introduced about 10 years ago, which, as far as I'm concerned, were the best behavioral tax system for pensions, because they encourage you through the tax system to put money in and not be worried about investment growth in the same way. And that was particularly helped by the abolition of the lifetime allowance, which was itself damaging. So we had some good reforms there. But now what we've gone back to is a system where, instead of being free to keep your money as long as you can, maybe spend other assets first so that there will be money left in your 80s and 90s, and you don't need to be frightened of that, because if you don't use it, you can pass it to loved ones for them to use. And once you're over 75, they can use it subject to their marginal tax rate. So it's not tax-free, it's just inheritance tax-free. But the old behavioral pushes, which encourage you to keep pensions longer, will now encourage you to spend pensions sooner, which means you'll probably have, if you haven't got a huge pension scheme, little or nothing left if you do live longer than you expect, and most people underestimate their life expectancy, as we know. So as far as I'm concerned, the unintended consequences of this measure are significant, are numerous, and are seriously negative for many people's retirement plans.
That's very interesting, Ros. Thank you. I mean, just looking at the government, and obviously when we were looking at the budget, there was a lot of talk about potential pensions tax reform leading up to the budget. And obviously we had that change, or the proposed change, as we talked about on the IHT side. Do you think, we obviously had the other changes recently, which you referred to in relation to the LTA. Do you think we are done in relation to pensions tax reform, or do you think we're going to have further things coming through?
We're not done in terms of pension reform by a long chalk, I suspect. The new government is intent on making significant changes to the way pensions work. My hope is that the forthcoming changes will be positive rather than the current changes we've seen in the budget, which are pretty negative. Even the increase in employer national insurance that we saw in the budget is going to have a potentially damaging effect on pensions in the long run, especially for lower earners and people who can't afford to put much aside. Because for them, the cost of their employment has risen, in some cases, pretty significantly. And the likelihood is that if the employer is currently contributing perhaps more than the minimum to a pension for them, the employer will be tempted to cut back the contributions as a quid pro quo for meeting the extra costs of employing someone, and otherwise they may have to lay off workers, or they may indeed just not get a salary rise or get very little in the way of increase. So I think if we can move towards a position where we have a positive change from pensions, such as, which I'm really hoping we will have, the government telling pension schemes that if they want the very generous tax reliefs that are on offer, they need to invest at least a good chunk of that in UK growth. UK growth is the mandate of this government. UK growth is what they want to achieve. Stimulating investment in infrastructure, in small business, small growth companies, those areas could be helped significantly, not just at cost to the taxpayer and not just courtesy of overseas investors, but by using our own domestic institutional firepower, a significant portion of which actually comes from other taxpayers anyway. The government has so far been spending about £70 billion a year on tax and national insurance relief for people's pensions across the country. That 70 billion could go a long way to boosting the spending that the government needs to invest in our long-term future, which it would like to find the money for, and which so far it's not clear where it's going to come from. So even if you were to say 25, 35%, pick a number, of all new pension contributions must be invested in UK assets, that could be a game changer for the economy, and also ultimately for UK financial markets and for the country into which our workers who are saving in a pension now will be able to retire and have a better standard of living later. I suspect there will, in any case, be some kind of tax reform review. And given the ideological nature of a number of the changes that we've already seen so far, trying to take money away from those who are considered to have the broadest shoulders, there is obviously the risk that some of the generosity of the current tax relief system will be reduced. Again, the hope might be that the money would be redistributed so that at least perhaps people who are only getting basic rate tax relief at the moment would end up with a slightly better contribution. Or the government may go a completely different way and look to, for example, mandate minimum auto-enrollment contributions, from which it doesn't then need to actually have tax relief in there. It might extract the tax relief from that, relying on the employer contribution as the big incentive, which it is. You know, the employer contribution is at least 3%, tax relief is only 1%. So those kind of changes, I am sure, will be under consideration.
Thank you, Ros. Ellie, turn to yourself in relation to what you're seeing in practice and those conversations with clients who are really at the coal face, trying to think about the things that have come through in the budget. What are you seeing clients saying in relation to this, and how's it working through in practice?
I think the key issue that I'm seeing raised by my trustee clients is the impact that it's going to have on them as trustees, and then in turn upon those survivors. Trustees are going to be responsible for calculating the inheritance tax on the death benefits, and they're going to have to pay that and report that to HMRC. And in order to do that, they're going to have to collect a lot of information from the individual's personal representatives, and this is likely to lead to delays. That's in turn, that's likely to lead to hardship for those individuals that are left behind, and potentially also, as well as all of the additional tax that we've been talking about, interest being payable on that inheritance tax if the information is not gathered in time for that inheritance tax to be paid over within the relevant timescales. So I think there's quite a lot to think about there if this is going to be introduced. And at the very least, we need a streamlined process to be introduced so that this is not an unnecessary burden on trustees that in turn will lead to this hardship for individuals at a time in their lives where they really could do without it. Another interesting point that I think this raises is that death benefits via pension schemes have for a very long time been payable at the discretion of the trustees, and that is what has kept those benefits payable outside of the inheritance tax regime. If there isn't going to be a tax benefit, then it raises the question as to whether or not it is appropriate for those benefits to be payable on a discretionary basis any longer. So that's quite a fundamental shift in the way that things have operated to date and in trustees' duties. So again, I think that's something that just needs to be very carefully thought through. In relation to the potential future tax changes that Ros also talked about, I think the only point that I would add is that, and I don't doubt that there are many more changes to come, is that actually what we could really do with is a period of stability. Pensions are a long-term investment. People need time to plan, and actually the more change there is, the less likely people have any confidence in the system, and the less likely they are to want to save into their pensions. So, you know, the inheritance tax introduction itself is going to discourage people from saving, or certainly beyond a certain point. And as Ros said, then you may as well just spend it as quickly as you possibly can. But just more tax changes is just going to introduce more instability. And I think that in itself will have a knock-on effect. And the only thing I would say in relation to the issue of productive assets, so not sort of tax changes related as such, is that I think there's a lot of positives to be had there, but it's a real shift in direction from the way things have been done to date. Trustees have for a long time been encouraged to be very risk averse and to reduce risk in their investment portfolios. And also, from a very basic perspective, the investment regulations don't really facilitate this. So I think we're going to need some some changes in legislation to facilitate it, but also some changes to give trustees the confidence that this is within the remit of their fiduciary duties.
Thank you, Ele. That's very helpful. So huge changes coming through, and it's interesting how one sort of seemingly at first glance innocuous change actually results in very significant both policy and practical implications flowing from it. And it will be very interesting to see actually how, when the government going through the consultation in relation to this, responds to these concerns that are being raised across the industry. And it'll be interesting to see whether we do continue with the same changes which proposed through to 2027, or whether they do in fact make some changes. So thank you, Ele, and of course to our special guest today, Baroness Ros Altmann. Fantastic session, so thank you for it. We'll obviously watch it to see how this develops in practice. And as we've all said today, I suspect we've not seen the last proposed changes in relation to our pensions tax regime. So looking forward to next month, we're watching out for our special festive edition of Pensions in a Pod. We're looking back at an eventful year in pensions policy, and we're going to think through what we can expect to see coming over the horizon as we head into 2025. Thank you for listening to the latest episode in the Pensions in a Pod series. Stay tuned for our next edition, where we will provide more perspectives into the world of pensions and benefits.